Today on the Accounting for You podcast, we're continuing our conversation with Matt Hale, a financial advisor with Truist Investment Services, and we're talking today more on the individual side about traditional IRAs, Roth IRAs, and 529 college plans. Welcome to the Accounting for You podcast, brought to you by the accounting firm of Adkins & Reynolds CPAs. This podcast is designed to provide relevant tax and accounting information to help you and your business succeed. If you enjoy listening in, please like and subscribe to our channel. Now, on to the show. Well, Matt, so do you have any like big success stories in coming into a business, setting up an investment plan, helping the business owner?
Yeah.
We had a person who was making a substantial amount of money, and they were retired. So basically, he was he was a lawyer, and he had all these fees from cases settled years ago starting to come in, but he was officially just retired, or he was wanting to retire, and he was making all this money he didn't need to make. And so what we did was, it was just him as the employee. It goes back to looking at each person individually, and we created a 401k plan for him with profit sharing. And we also looked at a cash balance plan, which is like attaching a pension. We got real creative, worked with his CPA, and he was able to put back $265,000 for a year in a deferred manner, which was awesome. His accountant he called his accountant, and he was like, I can do that? And he's like, yeah. He's like, well, why didn't you tell me about it? No, it was a great way. That's one of the examples of working with a CPA on making sure that what the tax situation is. But it was a big win for the client. Everybody won, and he was able to put back and save for tomorrow. And there's been a couple instances where we've really been able to help, and some of my favorite conversations are whenever you own a business and you have people working for you, you really need to make sure that your financial advisor is engaged if you have a plan. And you make sure that the employees know that they have a financial advisor as well, because a lot of people don't.
Right.
And I don't care if it's $250 or if it's $250 million, the people need to have access to some investment advice. They need to talk to their financial professional. And that's what we tell people is that, you have a financial advisor. If it's about your plan, you can call me about your plan. If it's about something else, you can call me about something else. I mean, but they just people need to realize that their financial advisor needs to be engaged and needs to be available for their employees.
Okay. Do we have any, Jay, did you have any more that you maybe want to talk about on retirement plans before we move on?
Well, certainly, I agree with what Matt said as far as getting professional advice from someone who knows on your retirement plans. We've talked before the podcast. Certainly each year is not the same. What worked last year may not work this year, or vice versa. It's very important to talk to a professional that knows what they're doing, and also works with other professionals like us, like CPAs, so that we can maximize, hopefully, investment return, tax savings, and all those at the same time.
Yeah, very good. Yeah. So, Matt, you mentioned the Secure 2.0 a while ago, and we kind of talked about maybe how that deals with businesses. So, what are some individuals? What are we looking at? What some changes there for individuals?
Well, one of the main things that Secure 2.0 did was it increased the age in which you start to have to take money out of your retirement accounts. It's called a required minimum distribution. In financial world, we call that RMD. Everybody loves a good acronym, right?
Yeah.
So, KFC. Anyway, but yeah, RMD, it pushed out to 73, and it looks like it's going to move out to 75. We'll see. You know how Congress is. They're really predictable up there. So no, it's good. It gives you more time to defer. You want to take full advantage of not having to take money out, because when you take money out of any 401k or IRA, it's fully taxable, and that's you want to try to avoid that. I mean, I like roads and bridges. Everybody's got to pay taxes. but I just, I don't want you to have to pay more than you need to. So you want to take full advantage of the deferral. Also, if you have college savings plans that have been in effect, like if you have a West Virginia 529 or any 529 in any state that you're in, it allows you. So let's say that your kid went to college. You started this plan when he or she was a baby, and funded it for all these years. He's 26 and he's on his own, and he's still got a couple $1,000s left in his 529 account, but you don't have any qualified educational purchases to make. You can roll that over into a Roth IRA now for the beneficiary, which is great. That helps the kid be able to have a tax-free pool of money. Roth IRAs are fantastic. So that's a really neat thing that we've not.
So it's great thinking that if you're putting money into that 529 plan, I get that asked a lot of me. I'm glad to know this, that, I'm going to put all this money into their 529 plan, but I don't know that they're going to college. I mean, he's 12 years old and wants to be a plumber. I don't think he wants to go to college. How are we ever going to use that money? And to me, I'm just like, you need to talk to your financial advisor. But now this is a great
great second. And it has to be in effect for 15 years, which is not that big of a deal if you start when they're a kid. That plan's been going for been going for a long time anyway. And another thing you can do, and it's a common thing, like a common objection to doing a college savings plan is, what if they don't want to go to college? You can also roll that over into for another beneficiary, for a grandkid. You can save it there as well. So
do you have any other we're talking about 529 and college savings, any other things there tell us what the 529 plan is, I guess.
West Virginia has a great program for 529s and allows you to save tax deferred for your child's or grandchild or whatever beneficiary you can, whoever your beneficiary is, for college, which is great. And you also get a state tax deduction. Which is, I'll let you guys can speak on that. It's a very tax efficient way. You get a little tax break for the state, and when the money goes into a 529, it's invested in a very similar way. You can invest it in different funds, or you can invest it in an age-based portfolio. So as the child gets closer to 18, it gets more conservative. Or you can invest in different funds in the menu and Hartford sponsors West Virginia's. And they do a fine job. But whenever the money grows in the investment account, and then when the child needs it for qualified educational purchases, he or she can use that for tuition, room and board, things like that. And there's no tax implications.
And there's no tax.
Right.
There's no tax so long as you spend the money, all the money on education related. And it's important to note, though, at least in West Virginia, there is a state tax deduction for contributions, but there is no federal tax benefit in your current year. If you put money into that plan, there's no current tax deduction. It's just it's kind of like a Roth IRA, where it grows tax free.
This is why you're a CPA and I'm not.
It's a wonderful product.
Yeah, it's a wonderful product, but people ask, well, do I get a tax deduction for that? And they're thinking federal tax. How much? Is that going to change my refund or something? No, this is not that for at least for the federal.
Nope.
And every state, I'm sure, has different rules on their 529 plans. So you'd have to check with your local state, your local county.
Yes, every state governs it differently. And this is my disclaimer is all that we're talking about is different strategies and different ways that you can save toward your financial goals. Don't take this as specific investment advice. If you have a financial advisor, talk to he or she, or you can call me. But don't take this as you got to go out and do this today. This is something you need to look at your individual goals, and then you talk to a professional.
Right.
So
So as far as in addition to 529 plans and other individual ideas, can you speak a little bit to maybe traditional IRAs, Roth IRAs? Maybe talk a little bit about that.
Yeah, IRAs are fantastic. IRA stands for Individual Retirement Account. A traditional IRA comes out of your gross, it's pre-tax. So you get to deduct that from you guys are the CPAs, but you get to deduct that from your income,
Right.
which is great. And then it grows tax deferred. When I say tax deferred, it means whenever you take money out in the future, you're going to have to pay income tax on that money.
Right.
And if you take it out before you're age 59 and a half, you'll also have to pay a 10% penalty on top of that as well. So it's not a very efficient way to, this is for tomorrow.
Yeah, that's a big thing that we see a lot. I would say every year, 2 or 3 clients, I'm sure, Jay, if you want to chime in here on this, but I'll have somebody that has a 1099-R from a traditional IRA cash out, and they'll say, well, we decided to pay the house off, or it's like, this was not the way to get that money.
That is a very uncomfortable conversation, especially if it's happening after the fact when we didn't know about it.
There's nothing you can do about it either.
Right.
You can't once that's gone for 60 days.
Yeah. Well, they said, well, I had withholding taken out on it. They said I needed to take at least 10%. I'm like, yeah, well, that was your penalty. Now you still have to pay income tax on that.
Right.
And yeah, you paid your house off, but guess what? You owe the government a lot of money. Again, those are instances before you make decisions like that. Call your investment advisor, call your CPA. Let's talk about this before you go and cash out a traditional.
I've seen people absolutely do that, and they don't understand the full implications. It could knock them up. It's because it's income, right?
Right.
And it could knock them up a bracket. I mean,
it normally does.
Yeah. I mean, listen, I love Ford trucks. But don't cash out your retirement you had at your old employer to go buy one.
Right.
You're going to end up taking a big haircut.
If you have that idea about buying a truck or paying off your house, please call your CPA or your financial advisor before you do it, so you at least know the implications.
Right. Yeah. And if you still decide after you know the implications I'm still going to do it, hey, that's your decision. Fine. But don't make us have that conversation with you at tax time when you're expecting a refund and we go, oh, I'm very sorry, you owe your refund plus that you normally would have got back, and you may not have the money because you've already cashed out your retirement account. You don't have any way to get it. So it puts you in an uncomfortable position, puts the advisors in an uncomfortable position of talking to you about that. So
also, another disclaimer, check your beneficiaries on your IRAs and 401ks. Make sure. Especially if you're on, let's say that you got divorced and remarried. It's a very uncomfortable conversation. Let's say that the husband died. His wife comes in ready, to take care of her estate and get her 401k. But guess what? It's the ex-wife that's the beneficiary. That's an Anna Price question. I'm sure she's seen that. I've seen it. It's not a very comfortable conversation. So just save yourself and just make sure. Let's say you recently got married. Go put your spouse on there or whoever, but just make sure you know who it is.
Right.
That's just a little housekeeping.
Keep that in.
Your family will appreciate you so much.
So you talked a little bit about the traditional IRA and how it worked, but there's also the Roth IRA, which is different as far as the taxation, different as far as, I believe, the RMDs, and it's a different animal.
Yeah, it's a great instrument for saving tax-free. So the difference between a traditional and a Roth is that said the traditional comes out of your gross, where the Roth comes out of your net. So you're paying the already paid taxes on this money, and you're investing the money grows tax-free. And then whenever you retire, you pull it out, and there's no income tax.
And as Matt mentioned, no deduction, federal or state, when the money goes in.
And you guys can speak. I don't know I know they changed the limit for income. There is an income limit for Roth IRAs, and I don't have that in front of me right now, but you need to check into that. Make sure that once you achieve a certain level of income, that vehicle you are no longer qualify for.
Right.
And you said there's no RMDs or required minimums on Roth IRAs. So they are a great way to establish a legacy. It's something that grows and keeps going. If your advisor is a good advisor, it grows over time.
And I believe
I'm kidding. I'm going to get in trouble on that one.
I believe with the new requirements that a non-spouse that inherits an IRA has to clear out that IRA within 10 years.
Yes.
That's a big difference between a Roth, which has no tax, and a traditional which if you have someone that's in a higher income tax bracket and may be inheriting a very high dollar amount IRA and has to do it in 10 years, that can really raise the tax level.
That is a great point. The stretch IRA is gone for non-spousals. And so let's say that your son or daughter inherits your retirement accounts. Jay said it has to be taken out in 10 years. And so you can try to spread that out over those 10 years, but you're going to pay some taxes.
Right.
So just imagine,
that's fantastic.
inheriting $2 million, and you've got to pull that all into income in a 10-year period instead of the old rules.
Uncle Sam will come get it. You know. So.
Yeah. So if we've got traditional IRAs, Roth IRAs, if I'm taking advantage of those, or I've got my own retirement plan, is there additional things that I can do? Is that maybe as an individual for investment? I mean, what if I'm showing up and I'm with you and I've got that? What are you going to talk about?
Well, you want to make sure that all the buckets are filled up. People will ask me, Matt, I want to open an investment account with you, and my first question is, are you fully participating in your employer-sponsored plan? SEP, simple, 401k, whatever.
Right.
And if they say no, I'll say, well, max that out, then come see me. Let me see. I'll say, bring me your statement. I'll check and see how you're about. But you want to make sure that you're filling up all these buckets that provide for retirement, for that obviously that can provide some tax benefit. But if you're maxing everything out and you have an emergency fund, which is a very important thing when it comes to investing, having a good emergency fund in case you lose your job or catastrophe. Or the other day, my air conditioner quit, and it's not a cheap date, but you want to have an emergency fund. So make sure you have that in place. Then you would look at, after all of these avenues are filled, you want to take, you've got your college savings, or if that's applicable to you, everything that we've discussed. Then you would look at doing a taxable and after-tax investment account. And this is a great complement to what you're doing, having multiple types of account, both tax qualified, non-qualified. That's the fancy term. Qualified and non-qualified just means, well, this is tax deferred. Non-qualified is there could be taxable events. You're gonna have interest that comes in. You'll receive a 1099 for this account, and you guys see them all the time. Let's say that I bought Apple at $20, which I wish I owned it at $20, but and then I sold it for $40. You're going to have to pay cap gains on those, and I'll let you guys speak because I think there's a lot more to how you calculate capital gains. But when you buy or sell in a taxable account, it does trigger, that activity, either gains or losses on your 1099 that you'll have to talk to your CPA about.
Right.
And one of the great things about having an account like that is, as Chris mentioned, the time that we may have heard from a client of, hey, I wanted to pay off my house, and they took it out of an IRA. They got hit with the taxes. They got hit with the 10% penalty. If you reach 55 or so, and you're in a position you want to pay off your house, well, you don't go to the IRA. You go to this taxable account,
right?
And there is no penalty there.
Yeah.
So it does help to get you to the age where you can take your IRAs out if you have a need for something.
Right, and you want to make sure that also your advisor is advising you when it comes to whatever is in your taxable account. If there's going to be a taxable event, then you need to have that discussion with him or her. Whenever market was down last year, right? So I had people say, I was like, no. I would tell them just let's hang on a second. Let's think about some other options because, it could totally, if the market's at a bad spot and you pull a bunch of money out, you're just taking all those losses. You want to make sure that if you have a large purchase coming up, like a house or a car, you want to make sure you talk to your advisor. People put stuff on my radar all the time. The person wanted to buy a car, and I will keep that in mind when having conversations with them and make sure that I do that at an advantageous time. And whether, instead of the opposite. It's being blindsided by something and be like, well, okay, here you go, bud.
Right. Yeah. Okay. Matt, so do you have any we've talked a lot about retirement plans for businesses, individual avenues for retirement, 529 plans. Do you have any final thoughts? Anything that you maybe wanted to talk about that we didn't get to today?
Yeah, just make sure that you're working with a financial advisor that's collaborative. I've known Jay and Chris for years, known you guys, and you all work well with financial advisors, and you want to make sure that they're being collaborative. You want to make sure that they're engaged and they know your individual picture. I just encourage you to reach out to that advisor. If you've not heard from your advisor in a while, I hear that a lot, and I get it. They're working and have a job and they've got multiple clients, but be sure that whenever you call, they answer the phone or call you back, and you're having conversations regularly about your financial goals. Make sure that they are doing things that are in your best interest, and they have an idea of where you want to be, instead of just, well, I have an account.
Right.
You are at the center of all of these topics that we've discussed. You're the focus of your goals, what you want your money to do, the purpose for your money. Make sure that you have someone engaged with you, and that gets into the weeds with you.
Yeah. All right. Jay, do you have any final thoughts on what we've talked about today?
Absolutely. Just again, as we've talked about in previous podcasts, it's very important for financial advisors to work together. Examples I will give is, I talk to financial advisors all the time, checking in to see what capital gains loss carryovers someone may have, which affect taxes. So it's all intertwined that we need to work together, because only working together can we move the client in the proper direction and make sure there's no conflicts in what they're doing, one professional with another, as far as what's best for the client. So it's very important to have a team that you trust.
Right. And I think, just to add to that too, I think it's a common theme in what we talk about, and what we talk about on this podcast is preparing and planning, because that's very important. Don't be just a reactionary to your financial life, whether that be your accounting records, the legal side of life, like we talked about with estate planning, with Matt, financial planning. It's all about planning and setting your goals and moving yourself forward to the future that you really want to have, and that's very important. So if you're interested in talking to us, about what we've talked about here today, especially the tax side of life on that, you can reach out to us to our accounting firm, and you know how to get a hold of us. All of our contact information will be in the show notes. If you're interested in talking to Matt directly, it'd be well worth your time to give him a call. All of his information and contact information will be down in our show notes, and you can get to him there. So if nobody has any other thoughts, we'll wrap this up today, and we'll see you next on the Accounting for You podcast. Thank you for taking time today to listen to our podcast. We appreciate listeners like you, and ask that if you enjoy what you hear, please like and subscribe to our channel to ensure you receive the latest episodes as soon as they come out. If you have any questions about the topic we discussed today, or would like more information on becoming a client, please do not hesitate to contact our office by visiting arcpas.com or theaccountingpodcast.com.